Centene stock is down over 50% year to date. As we can see here, the stock is down almost 53% year to date. It was at about $60 to $70 at the beginning of the year, and now it's down to $28.49. And in this video, I'm gonna be going over Centene stock. I'm gonna analyze the stock and use my intrinsic value calculator to see if we should be buying the stock today after this huge discounted price. And we're gonna be seeing if I believe this company can rebound in the future and if Centene will ever rebound back to previous levels. So let's first talk about what Centene does and how it makes money. Centene Corporation primarily generates revenue by providing managed care services to individuals through government-sponsored healthcare programs focusing on Medicaid, Medicare, and health insurance marketplace. So this company is mainly a government-based. They're not government based, but they are government sponsored programs where they basically provide that to individuals throughout the United States. As we can see here, this company is worth almost $14 billion, 52-week low of $25, so it's still right near its 52-week low, 52-week high at $80.59. So this company has had a very rough 2025. And guys, before we get into the rest of this video, please subscribe, because right now we only have about 12% of our viewers subscribe to the channel. It doesn't cost you anything. If anything, it's going to cost you a better learning experience in the future. I'm trying to do daily uploads every day, if not 2 videos a day, so please subscribe. I'm going to be making a bunch of videos on a bunch of stocks, and this is going to help you in the future learn more and help me in the future learn more. So please subscribe. Only 12% of you guys are subscribed to the channel. Doesn't cost you anything, and let's get back to this video. Thank you. And let's get into why CNC is down. Centene stock has had a significant decline in 2025, and it's because this company is a major player, like we said, in Medicaid and Affordable Care Act. And the reason why it's down is because of the slower than expected enrollment growth. The number of new members joining Centene's plans was not meeting their projections. Also, higher than expected patient illnesses has resulted in this company having higher medical cost ratios, resulting in lower margins. As we can see here, the company's announcement indicated that these issues would have a substantial negative impact on its 2025 earnings, leading to a projected earnings per share of $2.75, lower than previously forecasted. This news caused the stock to plummet with a single-day crash of around 40% and a loss of billions in the market capitalization. The situation reflects a broader challenge in the healthcare insurance industry, particularly within the ACA and Medicaid markets, where companies are struggling to balance premium pricing with the actual health costs of their members. So the main reason for this is because of the wrong pricing, basically bad timing from all these health insurance companies, resulting in higher medical costs and lower pricing, which in turn, obviously that's not good for the company because that will decrease their profit margins by a huge amount. And taking a look at Centene, look at what their revenue segments are. We can see Medicaid is a huge segment of 2024 in their recent 10K. We can see that's almost 60+% of their entire revenue. Also, Medicare is $23 billion and commercial $33 billion. So this company makes most of its money from government-sponsored programs through their health insurance. So taking a look at their recent earnings, which they reported, I think late July, they reported their earnings and the stock was actually up. But as we can see here, the earnings call sentiment was negative because of increased pressures on medical costs in Medicaid. While there are positive developments in the Medicare segment and improved Medicaid rate adjustments, the overall sentiment is negative due to the substantial financial loss and projected pressures. So this company did report pretty bad losses, where Centene reported a second quarter adjusted per share loss of 16 cents. So this company was a pretty good profitable company, but as of recently, due to increased pressures in the pricing, this company is now losing money in this past quarter, as we can see, primarily due to challenges such as $2.4 billion pressure from marketplace risk adjustment. So this is the biggest problem with all these health insurance companies. They've seen huge expenses on their ratios, and they're just paying so much for all their patients that they're getting terrible margins and decreasing margins because of the increased spending they have to have on patients. So with that being said, the company detailed efforts to reprice its 2026 marketplace portfolio. So they're going to try and increase prices in order to get back to profitability. Centene expects full year adjusted diluted EPS of approximately $1.75, revising its previous guidance of $7.25. Keep that in mind. That is almost more than 70% decrease in earnings per share expected. So they really decreased this guidance by a huge amount, and the stock price isn't even caught up to that huge decrease. So this is pretty significant guidance cut. This is a huge guidance cut with this company, and it attributed to an approximate $2.1 billion headwind compared to prior forecasts. So this is looking pretty bad for Centene. But as we can see here, marketplace portfolio by 2026 and break even for its Medicare Advantage business by 2027. Additionally, Centene revenue forecast for 2025 has been adjusted to approximately 172 billion. So they're actually supposed to increase their revenue still, but the increased expenses is really hurting this company. Taking a look at the lowlights, we can see second quarter financial loss. As we saw, they did lose money in this recent quarter. They also saw earnings pressure, like we said, huge $2.4 billion increase in pressure because of a morbidly shift with the product expected to run slightly below break even for 2025 in that marketplace area. So they're expecting losses in that segment. Also, elevated Medicaid medical cost trend. The Medicaid health benefits ratio was 94.9%. So normally that ratio should be in the mid to low 80%, but now it's all the way up to 95%. That's insanely high. Most insurance companies say United Health right now is at 89%. So this is a very high Medicaid ratio, and that's pretty bad for this company. Also, challenges in Medicaid behavioral health is really hurting this company. But there are some highlights for this recent earnings where their marketplace membership grew, where as we can see here, the membership of 5.9 million members driving more than 10 billion of commercial premium and service revenue. So at least the memberships are growing. So that is good, but once again, it's the profit margins that are hurting. Medicare segment favorability. The Medicare segment is expected to deliver approximately 700 million in pre-tax favorability, so that's good. And improved Medicaid rate adjustments. Centene expects a 2025 rate adjustment of 5%, stronger than the previous expectation of 4% plus. So they're increasing their growth. They're growing good on the revenues and sales side, but once again, obviously the earnings is terrible. Taking a look here, here's another good things about this company that could potentially help the rebound in Centene. Focus on their core business. Also, dominant market position where Centene is a leading player in government-sponsored healthcare programs. So that's pretty good, but right now with the administration, they're not spending a lot on these government-funded programs. But in the future, say we get a more democratic candidate and president, we could see increased spending for Centene in that government-sponsored healthcare programs. Also, acquisition strategies. While I don't really like how they're buying companies in gang acquisitions to increase their revenue, at least it's going to help them in the future. Long-term growth potential seems pretty decent, and technological and social initiatives. Centene is investing in technology and data analytics to improve care coordination, so that could help them in the long run get a better return on investment. Taking a look at the revenue, we can see, as I said, the revenue is just continuing to increase over time. So this is good for Centene. They're expected $47.6 billion for their next earnings, where recently they did beat on their revenue by a good amount, and it's still expected to increase quarter over quarter. So the sales continue to improve. But on the other hand, the earnings per share has been all over the place and then has decreased hugely. As we can see here, the company has lost earnings. They were negative net income just last quarter, negative 16 cents, and next quarter they're expected negative 9 cents. So they're expected to continue to lose money this next quarter, but I think they're going to be able to turn this around in the next year or so. And the reason I think a good rebound could happen in Centene is because look at these huge buybacks. If a company is buying back shares, that normally means they're confident in the company, especially if you see the buybacks increase when the stock price is tanking. As we can see here, they've been buying back at 7%. 7% is an insane rate for buybacks, and this just shows to me that the management is pretty confident in this company buying back shares. As we can see from 2023 to 2025, just huge buybacks from this company. And I like that about Centene because if a company buys back shares, number one, that shows confidence that they're good prospects for the future and they expect this company to still do really well and return back to normal. Number two, it actually increases our ownership in the company and gives us more earnings per share, because if they buy back shares, you actually get more earnings per share. So that's good for the company. Now, taking a look at my 7-step stock analysis, these are the 7 key metrics that I like to look at for my companies. This gives us a good sense of the financial health and valuation. As we can see here, we get 6 out of the 7 key metrics as check marks. The PE ratio is very low compared to the stock market. The stock market's at about a 25 PE ratio. Right now, Centene's at 7. So this means you're paying $7 for $1 of earnings per share over the past 12 months. So this is a very low PE ratio for Centene and looks really good. But I would like to add the forward PE ratio. While it's still really low, this is actually pretty bad compared to the PE ratio over the last 12 months. Since the PE ratio right here of 7 is from the last 12 months, the forward PE ratio is the expected earnings per share for the next year. So normally you want to see the forward PE ratio less than the trailing PE ratio. If it's less, that means you're actually going to be increasing the earnings per share. But since this is more than almost double the trailing PE ratio, that means they're expected to decrease their earnings per share by nearly half in the next year. So that's bad for the company, but it's still trading at a very low valuation. And if you truly believe this company can continue to grow and get back to normal, then it's still not bad. Taking a look at the revenue and earnings per share growth, they're still growing very good over the past 5 years. So each year they're growing at 17%, which is very fast sales growth. The earnings per share is growing at about 20%, but that is going to be decreasing because of the recent earnings. In the future, this is going to be probably negative earnings per share growth, so that's bad for Centene. But right now, it's still pretty fast growth, even with that negative earnings per share. Also, huge buybacks from this company. One of the largest buyback percentages I've seen in any of these videos at 4% each year. So this means they're confident in the company, and this is really good for us investors if you own this company. But the debt to equity ratio is a little bit high at 64%. I want this less than 50%, meaning that they have less than half the amount of equity value is debt. But it's still not terrible for a health insurance company. Normally, the health insurance companies run anywhere from 50 to 80%. So this is actually kind of on the lower side of most health insurance companies. So that's good. And analysts still expect them to grow at 15% each year for the next 5 years for the earnings per share. That's probably mainly due to buybacks, because if you factor in the buybacks of about 5%, say they buy back 5% for the next 5 years each year, that means they're only expected to grow the net income by 10%. And I expect them to increase those profit margins. So the revenue growth for the next, say, 5 years is probably in the single digits. But analysts do expect the EPS to grow that fast. So with that being said, taking a look at my intrinsic value calculator, I have to do future assumptions for Centene to get a fair value price and to see if we should be buying the stock today. So with that being said, taking a look here at the annual revenue growth rate for Centene, they've been growing pretty fast over the past 5 years. But I do see that slowing down. For the bear case, let's be very conservative here because health insurance has some uncertainty in the future. So let's say they grow 5% revenue, even though I think that's very slow. That's the bear case, so that does make sense. For the base case, let's do 8%, and for the bullish case, let's do 11%. This could be pretty low, but I'm going to be more conservative just because with intrinsic value calculator, I like to be more conservative than what I truly think, because then we get a margin of safety. And if it does come out to say that this company is a buy today, then we'll be even more likely to be buying this company because we'll be more inclined, since we even had a greater margin of safety with our conservative numbers. Now for the future profit margin, taking a look, this is going to be the hardest for us to predict because as we can see over time, the average profit margin has been anywhere from 1 to 2%. Right now, technically the profit margin is negative, so we have to take that into consideration. So with that being said, do I think this company is going to be in profit in the next 5 years? I would say probably. It's not 100% guaranteed, but I highly doubt that they won't be. So with that being said, 1 to 2% has been their average. So with the bear case, let's do 0.5% for the profit margin. For the base case, let's actually do let's do 1.2%. Let's just say 1.2% I think is pretty fair. For the bull case, let's just do 2%, even though that's a little bit off from the case to base case to bull case. It's a little bit different, but I think this could be what happens in the future. I think this is pretty fair. Now for the future PE ratio, as we said, right now they're trading at about a 7 PE ratio. Their future PE ratio is expected to be 14. For the bear case, for a company growing at 5% with such a low profit margin, I think this company probably deserves, say, an 8 PE ratio. For the base case, let's put this company at, say, a 12 PE ratio. For the bull case, let's say 16. That might be too high for this type of company, but I think that's fair. Now for the shares outstanding, I think they've been buying back at 4% each year. Do I think they're going to continue to buy back that fast? Maybe not, but let's say they buy back on the bear case 2%. Base case, let's do 3.5%. And then for the bull case, say they buy back at 5%. So with that being said, with Centene, I get for the bear case negative 8% return. But for the base case, I get a 15+% return if you bought it today. And then for the bull case, I get 37% return on your investment. So if you truly believe, I think the biggest question with all these health insurance companies actually is, do you think that they can get back to their profit margin levels, at least near it, where they were just in the past few years? Say they just get to a 1% profit margin and grow only 8%. Remember, they're growing at over 10%, 10 to 20% revenue. I think you can make 11.5%. So honestly, this company looks pretty undervalued right now. It's just, are you willing to take the risk in a company like this with all the uncertainty in the future? That's for you to decide and do your own research. Right now, personally, I'm probably not going to be buying this company just yet, but I've been interested. Maybe if we get back down to, say, $25 or less, then I might add a starter position. But honestly, if I were to invest in a health insurance company, I think I'd rather go with a company like Elevance Health or United Health, because those companies are still profitable right now. So with that being said, right now I'm staying away, but it does look kind of undervalued to me. So thank you guys for watching this video on Centene. Please subscribe, hit the like button, comment down below, and thank you guys for watching. See ya.